All right, today we're going to tackle a huge question in finance. How do you actually figure out the real risk of lending money to a massive company? It seems like a high-stakes guessing game, but we're going to show you exactly how the experts play to win.
So take a look at this number, $55,523,000,000. That's the total debt of just one company, a major energy player called TC Energy. And when you're dealing with numbers this big, one question becomes absolutely critical.
This is the whole ballgame. This is the core question of credit analysis, and it's exactly what we're going to unpack today. Answering it isn't just some financial puzzle. It's really an attempt to predict a company's future. And believe it or not, the market thinks it has a pretty specific answer.
Yeah, 3.43%. That's the market's calculated chance that TC Energy will default on its debt sometime in the next 5 years. So, where in the world does a number that precise come from? Let's build the answer piece by piece.
Okay, so to really get a handle on risk, we first have to imagine a world where there is no risk. A perfect world, right? Where every single loan is repaid on time, every time. This is how we get our baseline for value.
So this baseline is measured by something called the yield to maturity, or YTM for short. Just think of it as the total return you're promised if you hold a bond all the way to the end. But you probably spotted the big catch, right? It assumes all payments are made on time and in full. It's our perfect world starting point.
Now, a bond's price and its yield have this really simple, kind of seesaw-like relationship. If the price people are willing to pay for a bond goes up, its effective return, the yield, goes down. And naturally, if the price falls, well, the yield for whoever buys it next goes up. It's that simple. One goes up, the other has to come down.
Okay, so YTM is our perfect world number. But we live in the real world, and in the real world, companies can and definitely do fail. So how do analysts move from that perfect world to reality and calculate the actual cost of that risk?
Well, this complex idea of credit risk really just boils down to two simple ingredients. First, what's the chance the company won't pay you back? That's the probability of default. And second, if they do default, how much of your money is actually gone? That's what we call the loss given default.
By combining these two things, analysts calculate a single, really powerful number, the expected loss. And this isn't just a guess. It's a carefully calculated average of what they expect to lose over time, blending all the possible outcomes into one single figure. For instance, this is what an expected loss calculation might spit out. Now, this number blends every possible future scenario. It even accounts for the small chance of a credit upgrade, which would be a gain, right? Hence the negative sign. But that's weighed against the much bigger risk of downgrades or, an outright default. It's one number that captures the total blended risk.
So we know how to measure risk, but why does a company default in the first place? Well, a Nobel Prize-winning idea called the Merton model gives us a really simple and powerful way to understand this exact tipping point.
Let's use a simple analogy here. Think of everything a company owns, its factories, its cash, its patents, the whole shebang. We call those its assets. That's the company's total value. Now, to make this super intuitive, let's just imagine all those assets are just one single thing, a house. The entire company is one big house. Simple enough.
And what about all that debt we talked about? Well, in our little analogy, all of the company's debt is simply the mortgage on that house. So you've got the company as the house, and its debt as the mortgage.
So with that analogy in mind, just think about it for a second. When would you, as the homeowner, decide to just walk away, stop paying the mortgage? When does that default actually happen?
Exactly. It happens when the house is worth less than the mortgage. If the value of your assets falls below what you owe, you have zero incentive to keep paying. You just hand the keys to the bank. And that, right there, brilliantly illustrates the core idea of the Merton model. A company defaults when the value of its assets drops below its debt.
Okay, let's bring this all back home. We started with TC Energy, and that kind of mysterious 3.43% number. Now that we have the tools, let's actually decode their real-world credit report card.
So here we can see exactly how the market views TC Energy's risk over time. You see the chance of default is pretty low in the short term, but it grows the further out you look. And there it is, right at the 5-year mark, 3.43%. That's the market's consensus, and it's built from all the concepts we've just been talking about.
But, a number by itself doesn't really mean much. We need context. This table compares TC Energy to its peers.
You'll notice their debt to equity is pretty high and the return on assets is lower than the top performers. But check out the interest coverage. This tells you how easily a company can pay the interest on its debt. So TC Energy can cover its interest 2.3 times over. Okay, but the top 10% of their peers, they can cover it a much healthier 5.7 times. This tells you TC Energy has a way thinner cushion to handle any financial stress.
So after all of that, what's the single most important idea to take away from this whole explainer? What does this all really boil down to?
It really all comes down to this. The true value of a company's debt is its promised cash flow, minus the discount for the uncertainty of being repaid. Every single model and metric we've talked about is just a tool to try and figure out the size of that discount. It's the price of uncertainty.
And that kind of leaves us with a final thought, right? This whole framework of assets versus obligations, of value versus uncertainty, it's not just for corporate bonds. I mean, it applies to personal loans, career choices, maybe even relationships. Now that you have the model, where else do you see it at play?